Okay, here we are on Friday the 20th. Obviously, the markets have been in the steepest crash. Only 87 would be similar to this, and that was a whole different scenario. But markets, normally I've been reminding people that first bubble, whatever triggers it, and of course now it's clear it's the coronavirus to show the market's weaknesses from this big bubble. But the first crash tends to be about 42% in about 2.5 months. Well, this one's already been about 32% for most stock markets around the world and all the key U.S. indices in a month. Very, very rapid. And what I see here short term, the markets finally are stopping the rapid volatility up and down, and it looks like they're starting to bounce some. They only bounced once early on after the first crash. Well, this has been the second or deeper wave down. It looks like we're maybe going to get a bounce here, and that's what I've been saying lately. And it's either going to just be a couple days like the first bounce, and then we go one more wave down. So that first wave they call the one wave and L8 wave, the second wave down, third wave, and that usually is the strongest and the longest. And then we probably have one more. So again, either we get a couple days bounce, say into Monday or Tuesday or so, and then go right back down, and then towards those 40% figures I've been quoting, 44% on the NASDAQ is the extreme target on the megaphone pattern, and about 40% on the S&P and that or higher on the Dow. So that's one scenario. The other scenario, and this is tracking more with the first 2000 crash that was 41% in the first 2 months, that we get a bounce for a couple of weeks that doesn't go a lot higher, but it goes sideways more, and then we get a final wave down, and that makes the first wave low. And again, similar, 40% so target. So that's one thing. The other thing is like, what have been the safe havens here? Well, exactly what we said, except for a few exceptions. The Treasury bonds killed it, up 24% at best when stocks were down close to 30%. Almost a perfect, they made as much money. You would have made as much money as stocks lost instead of just hedging. And so that was great. But then, like the 10-year Treasury bond started at about 1.5% when the stocks peaked, went down to 0.375, the lowest ever. Then went up to 1.1, 1.2, and now they're at 0.99 this morning, right? Just under 1%. So what's happened here, it appears, is two things on the bonds. You got to remember, this is a short-term crisis. This is not the market saying, oh, we're going into a deep downturn forever, like in the 30s or something, or in the 2008 crash when things just kept getting worse. This is a temporary crisis, although extreme. So one thing, the bonds, just as they started to go down in yield, anticipating the slowdown in the economy and the stock crash 2 months before stocks went down, well, they're bouncing back up. They're seeing the rebound from all this massive stimulus that I've discussed in recent days and will continue to discuss. Just massive, the greatest ever. And now these checks in the mail coming and all types of bailouts and stuff. So certainly that's going to have some impact. And of course, the election always tends to push the markets up because, Trump's trying to get reelected like any president would, and everybody tries to cooperate, or mostly. The other thing that happened is that part way into this sell-off, the stock losses were so kind of fast and extreme that a lot of hedge funds and financial institutions and traders were having to cover their margin calls by selling the things that were doing pretty good or more liquid, like the Treasury bonds or the corporate bonds or even gold. Now, gold also did as we thought. Gold went up in the early stages of the crash, about 3% or so, and then down 10%. Gold was not a good hedge. It was better than owning stocks. So let's say you're down 7% in gold from the top versus 30-some% in stocks, but not a good hedge. And the high grade and AAA corporates didn't do. They went up about 3% at first, similar to gold, and then they went down when you get this short covering, selling of liquid assets, and the bonds starting to anticipate the turnaround. And the corporate bonds have done that as well. So, but generally, things, the safe haven is only the really safe stuff. High quality long-term treasury bonds in this case, and the US dollar has edged up during this whole thing when most currencies and finally the euro down. So again, this proves everything. First crash is going to come sudden and hard, and you'll wish you'd gotten out early. And this first crash is probably not over yet. Now, other thing, what am I looking at now? I am every day poring over the coronavirus statistics by country. Worldometers.com is a great site for this. Look at coronavirus. They've got total and by country and new, cases and deaths, and the deaths tend to be lagging by about 5 days, I found. Here's the thing I'm looking for. What do I think? S-curves. This is an exponential progression happening here. Started in China. Oh, it's already peaked weeks ago. It's already down to 0 new cases. It's over in China for now. Remember, viruses can come back until they get mass immunity, which we are not even remotely near, more like the Spanish flu in 1919. So, S-curve progression. Where am I focusing now? The epicenter outside of China is Italy. Italians, as I said, don't just kiss one cheek, they kiss both cheeks, on the lips, butt bump, or what. I mean, they're very affectionate. People down here in Puerto Rico are like that too. Italy has accelerated the most. They're up to 41,000 cases. The daily cases are still going higher by the day substantially. That tells me on an S-curve progression, we have not hit the 50% point yet, because the peak acceleration should be there. Then it should start to tailor off and still go up. So that would tell me at a minimum, before this is over, Italy's going to have 80-some thousand cases. I'm thinking we're getting close to that 50% point. I'm going to look at this the next couple days. Hopefully we can verify this. If you had to ask me to project today, I'd say by the end of the month, and this is key, by the end of March, we're just talking about a little over a week, that we could be at 90% where it starts to slow down. And that would be 90 to maybe 90,000, maybe 100,000 cases. And then it would end up ending like China today, just a little bit higher. It's say 110,000. Death rates in Italy are 8.3%. Iran is 6.1%. I think Spain is 5%. Those are the high ones. U.S. is more like 2%. France, 2.2%. China was 3.8%. So this is the highest infection rate. So what I'm looking for, folks, very simple. If Italy can start to peter out like China did, people, I think, will start to see the daylight here and realize that this is not going to last that long. Now, again, remember, the virus can come back. 1918 Spanish flu. It first came in the summer, in the last year of World War I. A first surge. They didn't say a damn thing about it like today, or even worse. They didn't want the soldiers to panic, didn't want the public to panic. That was in the summer. What it did, the biggest surge came as soon as it got cold, because these viruses like cold, dry, and do not like warm, humid. Biggest surge in October, November, and then a final surge at the end of winter into February, early March. So the virus came back in 2 more surges. This time, it's surging at the end of winter, which means it should taper off starting in April. So another reason for tapering soon, and that's going to give us some daylight. But this virus could come back with a vengeance next fall. So if we do get over this in the next month or so, and the markets start to rebound with the stimulus and the election, and then again, we're not going to see new highs at this point. This thing clearly looks to have peaked at this point, but there's a lot of stimulus. So there is going to be a rebound. This virus could come back. I've been saying from the beginning, regardless of what happens here after the election, if not a couple months before, this market's going to start tanking, seeing the end of stimulus, an overstretched economy, and 2021 is going to be the worst year in the stock market since 1930 or 31. And I can tell you today, my projections are still the same from 20 years ago. This winter season and this stock market crash will bottom right around the end of 2022. Many cycles point to that. The fact that it's now peaked in early 2019, taking the same length and near degree of the 29 to 32 crash, that would put a bottom at December 2022. So again, I'm just making really good guesses here. I'm making guesses about Italy. But in turnaround situations and crises, the best managers, the best people get the best data and react accordingly and then revise. So I will revise all of this, but that's what I'm telling you now. I think this thing's peaked. I think we got one more downturn to come. It could be substantial. So stocks, if they're down 30% now, typically could be down 40%. Do you want to sit through that? If you don't, if we do get this rebound in early next week continues and we get back up to about 7,800 to 8,000 on the NASDAQ. Don't wait for more than that, and don't wait for 8,000, the best case. Be selling into this next rebound. If you say, I do not want to take any more, and even if we get this fifth wave down and it bounces, that 8,000 target is still one of the targets of where it's going to go even in a rebound. If it lasts long, an election could go higher, but do you really want to sit through that? If the markets bounce longer, then look for another crash down, maybe sometime in early April or late this month or something like that. And then from there, we'll get a rebound. We will very likely get a 3, 4, 5 month and maybe longer because of the election and massive stimulus cycle. Everybody's bailing out. Everybody's buying more bonds, QE, than ever. Fed is given a 3 to 5 trillion lifeline to repos. Now, by the way, since our last update of the Fed balance sheet last week, I think it was the 12th. Yeah, the 12th. It going up to 563 billion, so above that 424 level that had kind of topped out. So that was a big surge. And since then, with this new credit line for repos, banks have withdrawn net 200 billion. So we're up to 763 billion. So there's way more stimulus than before the virus erupted and stock market started to crash. All of this bailouts, all of more bond buying, all this sort of stuff. And the repos, the banks can keep drawing money. Plenty of stimulus to feed a stock market rebound and plenty of stimulus to give some sort of rebound in the economy. We will be in a recession. We're already in a recession from my point of view. It'll get deeper into the second quarter, maybe bleed in the third, but it should turn around some. I'll also show next week, this is a lot like the 80 to 82 cycle. For a sharp recession in the first half of 80, a lot of stimulus, kind of a station, a little bit back off in unemployment, a little bit of rebound, and then the real downturn from 81 to 82. So same thing. Here we're seeing down in early 2020. We get a rebound towards the election. I don't even think it makes it to the election, but if it does, it's over then. And then the long downturn from sometime in latter 2020 into late 2022. Very similar to the 29-32 scenario, very similar to the 80 to 82 in the economy. But of course, the stock correction, way bigger here. We weren't in a bubble. We're at the late stages of a long downturn in 1980 to 82, so stocks were not overvalued. When the Spanish flu hit in 1918, stocks were not overvalued at all because we're in the worst of World War I. The worst flu in all of modern history. Stocks were down 10%. And then the end of the war and then the rebound from the virus, they went up from there. But so this may have been triggered by the Corona crisis, but a lot of people say, oh, well, this one's the bubble. The bubble got triggered by this. The stock market would not be down 30%, looking towards 40% plus if it weren't, because it was so bubbled up and the economy is so weak that it keeps taking trillions and trillions and trillions and trillions of stimulus to keep us growing at a mediocre 2%. This thing is dead. Monday was the announcement. The doctors find the stock market finally defibrillator. Keep shocking this economy. Treating while you wake it up. The biggest stimulus announcement at all into Sunday night. And the next day, stocks crashed their biggest one-day point ever, 3,000 points, saying, we don't care anymore. This doesn't work. End of QE working. I said this was going to happen. I said the first crash would be 40% when it finally came. Give or take, all of this stuff's happening. So what I'm going to be doing weeks ahead and going forward, getting people ready for the scenario. Again, first big crash, You get a 3, 4, 5 month rebound that will retrace 50 to 60% of that crash typically. Could be a little more this time, the stimulus. Could be a little less because things are so weak or if this virus stays strong. And then the big downturn happens more steady for about 2 years after that rebound. So this is what we got to see. If you're going to buy stocks and get back in, you're in it temporarily. Don't listen to people say after this 40% crash, oh my gosh, this is the buy of a lifetime. I've already heard tons of people saying that on CNBC. It is not, will not be. This is the beginning of the greatest crash of your lifetime. And it is foreboding the buy opportunity of your lifetime, but that is not going to come probably till late 2022 in stocks and 2023 forward in things like real estate, commodities too. So again, stay tuned and we'll be giving you more evidence and more scenarios for this next week in the economy and markets.